And Richard, this is kind of new ground that we're watching for the Fed. Earlier this morning, Mark Grant said he thinks this is the most important Fed meeting and decision that we'll be getting for a very long time. This is kind of where they have to readjust and let the market know what's coming. What do you anticipate that we'll be hearing?
Well, I would be surprised if they didn't do what everybody's anticipating, which is to announce an earlier wind down of the Federal Reserve Bank expansion, or the balance sheet expansion. It's all been priced into the market. It was just pointed out, there's a little weakness recently, but if you look at what Steve just pointed out, I think it's been well broadcast. If they don't do that, then I think it could have a different kind of reaction. But Becky, I have been saying on this show forever, since they put in the decision rule that they have, which is averaging inflation at 2% plus, that it was a mistake. And the reason it's a mistake is because, setting aside market reaction, it takes time for monetary policy to work its way into the real economy. And waiting to see the whites of the eyes of inflationary pressure not being transitory, quote unquote, and then acting, builds in expectations amongst businesses and consumers. And then it leads to greater inflationary pressure. And by the time you act, then it takes 12 to 18 months to impact the real economy. And meanwhile, expectations build. So I think the fault here was the new model that was adapted. To be sure, the old way we used to do things was highly inaccurate. We weren't great forecasters, but we could head either inflation, deflation, whatever pressures we wish to ahead. Instead, now they wait and react. And if you wait and react, it takes longer to quell those forces.
Let me play this out a little further, because Larry Summers, who obviously is an incredibly bright guy, somebody who has been through all of this and gone and thought through a lot of what's out there, has said this morning that you got to, at this point, realize that we're at the risk of spontaneous deflating of financial markets. He said you should be presuming at this point that the Fed is going to be much more aggressive and have at least 4 rate hikes next year and more to come after that. Is the market prepared for that?
Well, we'll see. I don't know. But it doesn't look like it the way assets are being priced in the trading markets, particularly the equity markets. The short end of the yield curve, the 2 to 5 year space, I think is already discounted 2 to 3 rate increases. But again, Leisman just pointed out, you do a couple of rate increases, 3 rate increases, you're somewhere between 75 and 100 basis points. That is 1% or 0.75% of 1%. I don't consider that to be very tight. However, it's the direction that counts. And if they indicate at this meeting or future meetings they're going to move faster in that direction, then perhaps the market will have a little bit of a surprise and may have to react accordingly.
I'm of the opinion that they're probably not going to be that clear or that direct, because not only are they fighting inflation, which Jay Powell has made pretty clear he's going to get more hawkish and more aggressive with going after, they've also got the rise of the Omicron variant and trying to deal with the unknowns of what this brings. My guess, tell me if you think differently, would be that they're a little more opaque about the exact specifics on this. They give us some direction, but maybe that's about it.
Yeah, Becky, the central bank should always be opaque. And I think they will continue in that tradition. So we'll see what Powell says, how he dances around it. I think he's gotten very good at his press conferences. We also can look to see where he looks down and reads, as opposed to just feels comfortable talking. I have noticed that
that's a good tip. You're right. That's a good tip. Things that I want to make sure I say very carefully, and that I don't say anything that's going to really make the markets wobble. I want to be very clear in the things that I am reading versus I can answer this off the hip.
I did notice in his congressional testimony, the most recent ones, he's much more confident since he got reappointed. And again, I want to stress this, which people may not appreciate. He owes President Biden nothing, because we know the White House worked extremely hard to give this job to somebody else. They couldn't get the nose count in the Senate. And so in my view, where I don't have that talent, I'm not there. I would feel very comfortable in my own skin right now. And he should just do what he thinks is right. And again, he came up through the capital markets and the credit markets. You have to understand this. That's his background, just like Paul Volcker The only two Fed chairmen of recent note that didn't have PhDs, including Volcker. He does not. He came up through the credit side. He understands markets. But remember, Volcker had to do something very painful because things got out of control. So I have great confidence that he will move forward in the right way.